market gets spooky in 2024. I mean, certainly seasonality hasn't played out as close as I would have liked it to, but it hasn't been bad. So there's that. That's always a trade-off. Recession is probably back on the table. I'm going to skip that this month, but we are certainly keeping that in mind. I'm going to look at current money flow and I'm going to look at spotting market trends faster, something that we've been working on and using to tweak our strategies a little bit to be a little bit quicker on understanding when market shifts are happening. And it's been pretty good so far. It all kind of ties together. So we'll start with that. And I know Will has the most content today, so I'm going to be a little bit shorter than usual. So let's start with seasonality, the Seasonax data. And this is for the last 3 elections, we're looking at the S&P before, 30 days before and 30 days after an election. And I thought the last 3 were really good ones to look at because they're all so different. There were some that were contested for a while after, some we knew right away. But so it's a good mix of what happens. But so typically, I think we're 26 days, so we're around here. No surprise. Market is expected to actually chop sideways and maybe even go up a little bit for the next maybe a week and a half. Then you get a little sell-off. I think it was about 2 weeks into the election, and then you get an election pop. Now, I'm sure there will be a bit of a panic. I'm sure volatility will go crazy right there. I think a couple months ago, I showed the VIX term structure showing that volatility is expected to go crazy in October and then calm down in November. So I think that's where we're at. I don't think much is going to change no matter who wins from a market standpoint. Market fears unknown, so I don't think there's as many unknowns as we may have had in the future. And that's my rough guess, because the market does not seem to really care about it this much. Anytime some news comes out, it just doesn't really have much of an effect. So I'm somewhat optimistic on the market being pretty good through the end of the year from the election. That's what we're looking at. As far as data, our long-term trend is up. It's actually up above both trend lines. One is more of our short-term heads up if something's wrong. Back here in, I think it was April, we had a couple of weeks of iffiness, but really money's coming into the market, so you really don't fight that, right? If the money's coming in, that's where the trend is going to follow, right? If money is falling out, the market is going to follow the money out and follow the market down. As of right now, we're actually holding the short-term trends. It doesn't look that bad, even though we've had a couple little choppiness, every couple of months or so. It's just not there. This is wild. Our midterm cycle, money flow is actually pretty ugly right now. In the short term, this is a little bit different factor. But in the short term, I would expect the market to be selling off, and it's really just kind of going sideways. I'm not super afraid, because we've had some other times where it just kind of bounces and comes back, bounces and come back. Like I said, about 4 weeks ago, maybe 8 weeks ago, we had these quick little bounces, quick little sell-offs, and a quick rebound. And I'm going to show that at the end about how some ways that we found that we can look at getting on those quicker in the future. So I'm liking that. But yeah, money flow is ugly, but big picture is not bad. So it's a trade-off. The market doesn't seem to care so far. So that's where we're at on the money flow. Interestingly, we're 7-4 as positive sectors of the S&P versus negative sectors. The negative sectors are all defensive names. So that's consumer staples, real estate, utilities, and healthcare. Now, interestingly, we've owned most of these early in the third quarter, but that has shifted back because the first half of the year was all in the technologies, I think even energy was good. Financials were okay. So all these names over here were quite positive in the first half of the year. Then we had a break for about a quarter, and now we're kind of shifting all back into those growth names. So that's not a bad sign of the market. The market doesn't seem to be afraid of much right now. So that's an interesting take. And then, of course, to alternate that is here are the defensives in the red lagging box, but if they push up, that could be more growth into the market. Everything over here, it is coming into weakening. The market has been grinding somewhat sideways over the past maybe 10 sessions, so that's about 2 weeks. These could also shoot back up into the leading. So I'm not really concerned until they get down into this, they start pushing towards the red lagging box. And I post this on Twitter every single Friday, so you can always see where we're at, and I make a quick commentary of showing the stats. So it's worth checking up, and it's fun to read the history, and you can see where it's been week to week to week, and it almost always plays out as expected. When you see these things get weak, they kind of fall into lagging, and then they take off into momentum. It's almost fascinating how consistent that happens. So RRG is a very cool way to look at market cycles and how they're going. And then finally, looking at how to get into the market a little bit faster. So the top is a regular, I believe this is the Dow I was looking at. It works in other charts as well, but this, for my example, it was the Dow. So back here in early August, there was a very quick sell-off, right? It was like boom, 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 and then it just came back, right? So what was interesting is the normal way that we look at it, we'd say, oh, it turned orange down here, and then maybe it was here that we need to start playing defensive and then maybe get back in there, which is not ideal. But the key that we found is removing time from the chart, and that's what this does. It's really just looking at movement. Like every time it moves X amount, you get a new bar. So we're not, if the market's flat, not much happens in these charts. But what I find interestingly is this was saying, hey, it's moving down enough, really on this green bar where we would normally say things are fine. It would say, hey, we need to maybe a heads up that we need to play it safe. So that might have been good. And then interestingly, instead of getting back into here when it pushed into leading or into strengthening, back here it said, hey, it's, this has moved up enough. And this was all like one day. All this craziness is actually really from here to here, it's like 3 bars. You get all this data. And it's saying, okay, things are bad during the day. Things are up enough on that second day up. And that may be a time to start nibbling back in. And even here, it's green and things are all great. But this is saying, hey, it might be weak enough to take a break and then back in right there. Neat little angle, something that we've been playing with. It's helped us on a couple models so far. We're still kind of in the testing phases of it, but it's done some neat things of helping us get in the market sooner and out sooner before things get bad quickly. So I'm really looking forward to using that more in our strategies.